Jim Caron, the numbers, I think, had enough shock factor. And, I've been doing this a few years. The markets didn't move for 30 seconds. It was like stunned.
Well, this is a big miss. And like you said, many economists, nobody really had this number. I mean, this is, look, one of the big positives of the first quarter was that there was a narrative that we were just growing very, very strong. And this is unwinding a lot of that narrative. So now this is actually a very friendly number for the Fed.
Yeah.
Because what the Fed has been saying is that we're going to get this economic cooling, and we don't have to worry about potentially these inflation numbers that have been coming out hotter than expected, that it's all going to correct itself. This is a major step in the right direction. It starts to put June back on the table.
You think so? Okay.
Potentially, It puts June back on the table. Now we're not seeing that right now in terms of the price action of treasuries. Now, of course, everything's going to depend on, is there a revision to this? Was there some type of an anomaly? We've got to go through the numbers. We have to go through the math of this whole thing. But effectively, a slowing like this is going to bring down some of the inflation angst that's been in the markets.
Yeah, I mean, I think it's really interesting. I was looking at the WIRP function to see how that's going to start reflecting any changes in the market's expectations for the Fed. And you're right, it seemed like the market, we started the year with 6 cuts potentially. We got down to, 2 or even fewer than 2 just as recently as yesterday. And maybe this will cause the Fed to maybe think about being a little more dovish.
And there's one other thing that I really want to bring up, because I think this is very, very important, is that earnings expectations are highly linked to GDP growth. So I know we're talking about the bond market a lot. Let's talk about the equity market just for a second here. If earnings growth is slower in the first quarter, that's going to change a lot of people's full year earnings estimates for 2024 and potentially even going forward. So the equity markets are actually responding more strongly on this, because it's basically making many analysts take down some of their robust earnings expectations.
If you're joining us, we are commercial free, and thank you for that. To the top of the hour, Jim Caron of Morgan Stanley is with us. We're thrilled that Anna Wong, our chief U.S. economist, will join us here in a bit. And because of these seismic moves in the market, we're ripping up the script, and we'll get somebody here after Dr. Wong, I think, to focus more on interest rates. We'll see what our team does in booking that. Futures have not plunged, that's too much to say, but down 1% on S&P. The Dow futures down an equivalent 1% off of Meta, and maybe worry about Microsoft and Google. NASDAQ down 1.3%. Paul Sweeney can't get the 2-year back to 5%, but 4.97% as a rebound of 5 basis points. 10-year yield gets my attention, 4.68%. The real yield, which is really what I look at, is a shocking 2.26%, and that climbs ever up. Obviously, dollar churning, and the yen, we're looking into Sunday evening in America. Monday morning, what will the Japanese do with a euro yen of a 167, which we saw earlier? Jim, I got 8 ways to go here, but let me go to what I learned in school. The textbooks. You have physics envy, which is why Karen's here. And the answer is you got to hang your hat on one thing. And to me, it's the 10-year inflation-adjusted yield. And forget about the math, and let's not impress people with a log. On a semi-log basis, I'm getting out to a real stress point at 2.26%.
Yeah, the real yields are certainly moving higher, and to the point where this has historically demarked a bit of a slowing of economic activity. But none of this is happening in synchronicity, to the extent that one of the things that we're also seeing is the prices paid components and the pricing components of the internals of the GDP number are actually causing the bond market a little bit of angst here. So on one hand, we have a weak headline print. On the other hand, we have some inflation and pricing pressures. So in theory, inflation is a lagging indicator. So inflation should fall on these things, but unless there's something that's just going.
Well, what's Ellen say? Stop. I mean, you got a team of 14 people. Karen's there with 2 interns. They're from Bowdoin. But Ellen Zentner's got like 25 people. What do they say about the disinflation vector at Morgan Stanley?
Yeah, so look, I mean, it's as Ellen likes to put it, it's going to be a slow, bumpy path lower. So, inflation is likely to come down. It's just a question of, does it come down in a linear fashion where people are comfortable with the pace? But the trajectory, nobody's really disagreeing with the direction of inflation. Most people agree that it's coming down. It's just a question of, is it coming down fast enough for the Fed to start their rate cutting cycle. And that's the debate. So what Ellen pushed out in terms of her Fed forecast was from June to July, that the first rate cut would start to come in July. And I don't think that this number might not change that in many ways.
Okay, is there an inertial force here right now? Are we getting to where there's enough yields? We're on truly on a physics basis. I make jokes about it. But seriously, are we getting a weight towards an inertial force of higher yields?
Yeah, so I think, as you were saying earlier, many people came into this year overweight fixed income, long duration, and this has been correcting. Now, the positives around this is that at this backup in yield, if you're looking at a multi-asset portfolio, you can start to think about owning U.S. Treasuries. You can think about owning bonds, high-quality bonds now, as a reasonable hedge against your equity, and you can actually potentially get some return from these levels.